Last year, I was able to refinance my loan 2 different times without coming up with any money out of pocket. In fact, it was a free refinance. And people keep asking how I was able to do that. So Josh and I are going to spend a little bit of time today and talk about lender credits, how you can use them to your advantage so that you're not coming up with a bunch of money out of pocket or building that cost into your loan.
Perfect. There's 3 key concepts that we're going to need to talk about today. That is to base camp, sort of to understand everything else, is the idea of a par rate or a 0-point rate. Par just means the lender doesn't charge you for it. The lender doesn't give you a credit for it. 0 points. That is the 0-point rate at which you're not paying anything or getting anything. So from there, we can go one of 2 different directions, Jeb. A lot of times I get people asking me, well, can I buy points? Should I buy points? What do discount points do for me? So we have that side of it. And then we have the other side, what you're talking about, which is a lender credit. If you are short on cash, if you're doing a refi and you don't want to trade your equity for a lower interest rate, then we can go to a higher interest rate and the lender will pay you for that. So let's start back, Jeb, at that concept of a par rate. The lender on any given day knows what their rate requirement is. That's going to yield them over the life of the loan, the money that they want to make on the money that they're lending to you. So that's the par or 0-point rate. So for the examples we're going to go through, we're going to keep it super simple because this can get a little bit complex. But we're going to use the example of, say, today rates were 6.75%. And we're going to use an example of a $500,000 loan. We're going to show you what you can do with discount points to buy the rate down. You're going to pay more to get a lower rate. And then on the flip side, we're going to go through what Jeb's talking about, which is more common on refinances, but some people will use it on a purchase as well when they prefer using lender funds versus their own. And that's taking a slightly higher interest rate and getting a credit from the lender.
Good stuff. So Josh, let's start with discount points, right? This is the idea that you are going in, whether you're buying a house or you're refinancing, and you're buying down the interest rate, right? A lot of people out there buying new construction. The builders are giving money, incentives, if you will. And a lot of people are using money to buy down interest rates. And at the same time, a lot of people don't truly understand what any of this means. So let's kind of take it a step back. I mean, this is a 101 when talking about points and lender credits. So we're going to kind of take it from base level here, guys, just so that you fully understand exactly what we're discussing.
100%. And a very important note here, we are not talking about paying money for temporary buy downs. Today is permanent. We're paying points for a permanent buy down, or we're taking a permanently higher interest rate to get a lender credit. So let's use that example again today. $500,000 loan. Let's say today's par rate is 6.75%. The lender says that is what we require to loan you $500,000 for the next 30 years. And for whatever reason, you say, hey, I need a better rate. I need a lower interest rate. Well, the lender says, okay, but we know what our profit is that we need over the life of that loan. So if you want to pay us less every month, which is what you're telling them you want to do with a lower interest rate, they're going to say, fine, we need a payment from you up front to compensate us for the lost interest over the life of that loan. So in essence, you're making a lump sum prepaid interest payment at closing so that the lender still gets the yield on their investment in loaning you that money over the life of the loan. And as a rule of thumb, people get hung up on this because it is never perfect, but a rule of thumb says if you want to get a 0.25% lower interest rate, it's going to cost you a point. If you want to get a 1-point lender credit, you're going to go higher in rate by 0.25%. Again, not perfect. You always have to ask your lender. Sometimes it's better, sometimes it's worse, but that's a rule of thumb that you can use for what you're going to get in exchange for your discount.
And just to be very, very clear, that Josh is saying a 6.75 rate would be the rate that you'd be quoted. If you wanted that 6.5%, it's going to cost you $5,000. That's 1% of $500,000. So you're paying $5,000 up front as part of your closing costs in order to get that lower rate.
You make a really good point there, Jeb, because one of the questions I get most often, having done this for 30 years, it's the curse of knowledge. You know something and you don't remember what it's like to not know it. Say, okay, if you want to get 6.5, it's going to be a point. People say, how much is a point? A point is truly 1% of your loan amount. You can pay more or less than 1 point. It can be 3/4 of a point. It can be 0.9 points. It could be 1.25. It could be 1.5. But in general, when people ask, well, how much if I pay a point? And that rule of thumb is it will get you a quarter. So Jeb, you made a really, really good point. Once we go and say, wait, $5,000 to get a 0.25% lower interest rate, is that a good idea? Well, numbers never lie. We have to look at the numbers. On a $500,000 loan, that's going to lower your payment about $83 a month. So $5,000 divided by 83, it's about a 5-year break even. And that is right roughly where it always comes out. Sometimes it'll be a little bit less. Sometimes it'll be a little bit more. So from that perspective, you have to look at it and ask yourself, what are your thoughts or expectations going forward? So Jeb, I always like to ask, why would anyone pay points? Who would do this? Why would the lender offer it? The lender is in a unique position. You are one person, and there's some uncertainty in what you will do over the next 3, 5, 10 years, despite how strong your plans might be. From the lender's perspective, they're going to make 10,000 loans this month. When we talk about a group of 10,000 people, they have history that's a pretty strong guide of how those people are going to act. How many are going to sell the house in the first 3, 5, 10 years? How many are going to refinance and get out of that loan in the first 3, 5, 10 years? So we see that 5-year break even being pretty consistent because the lender knows over thousands of loans, they're going to essentially get what that yield was that they wanted on their money up front. So when we look at that, you got to ask yourself, what do you believe about the future, both your future and the future of the economy, to be able to make that decision?
Well, Josh, I think I want to skip a little bit ahead here on our outline and actually talk about when it actually makes sense to do this versus when it doesn't. And then let's talk about lender credits, because I think it's important for people to understand. Everybody thinks, hey, I just want the lower rate. I'm willing to buy it down, even though it's $83, savings. I just want the lower rate. And we both know that most people don't even know what their rate is after they close. Give it 30, 60, 90 days. They just know how much they pay per month. And for most people, the question is, would you rather have $5,000 in the bank or $83 in savings? But that's not really the only thing to consider. So let's talk about good scenarios for discount points, and then when you probably should avoid it.
So to me, the best one, or the one that often comes up the most, I was actually looking at a file that we closed in December of 2023. Something popped up on it, and I was looking at the loan docs, and that guy paid almost 2 points. And I look at it, why in the world? We do 99% of our loans. Jeb, you know this. We don't have borrowers paying 2 points. And I look at it, why did we do this? Well, we were in the middle of when rates had gone up, and he was not going to be able to buy that property, which was a very good deal. He was getting it for about $200,000 under market. And if he didn't pay that almost 2 points, which was $7,000 or $8,000 in his situation, he wasn't going to get the property. So to be able to benefit from getting this at a big discount, he had to do that to even be able to qualify. He didn't make enough income to qualify at current rates, had to buy it down. Another situation where I always throw this out there and people go, well, I don't know that. How would anyone know that? If today we knew this was the lowest that rates were ever going to be, it would make sense to pay and buy that interest rate down for anyone who thinks they're going to be in that home for longer than 5 years. Because the last 25 years, it's all money to the good. But the reality is, you're probably going to sell that home in 7, 12, 15 years. So it's really not a 30-year term. And then we also are likely to refinance about every 5 years. So unless you knew for a fact that rates are as low as they're going to be today, I caution against paying for this lower interest rate. A lot of times it's a vanity interest rate. Well, my neighbor got 6.625. So if I pay the point, I can get 6.5, 6.49 and tell him I got a better interest rate. We're not here for vanity. We're here for financial planning purposes. How do we get you from here to a point in the future with as much equity, with as little payment, with as little cash out of pocket as possible? So really, I don't love paying points. Especially when it's just for some magical target number. And what I always like to ask people, so use our example here, would you rather have $5,000 in the bank, or would you rather have someone give you $83 a month? Because that's really what we're talking about here is, are we wanting to save $83, or do we want to have that $5,000 available to us? And a lot of our clients, a lot of the listeners here to the show are first-time buyers. We're not talking about someone that has $50, $60, $80, $100,000 sitting in the bank when they're done. An additional $5,000 is a significant investment, and it is important to remain as liquid as possible. So when we talk about here on the show, Jeb, that we're not big fans of paying points, If you are someone that does have hundreds of thousands of dollars in the bank, and it's personal preference, and you want that low interest rate and that low payment, and you value it more than having an extra couple $1,000s in the bank, you can make that decision. For most people, the right decision is not to pay points.
Well, that, and on top of that, if you're somebody who plans to take advantage of lower rates as they continue to trend down, because right now we're towards the high end of where rates have been over the last 15 years. I mean, 10 years. It's, we're still, we're in the sixes, fortunately, at the moment, but we've been sitting around 7.25% for an extended period of time. So the likelihood of interest rates moving lower is pretty high. Now, going back to 3%, probably not as high, but moving down into the low sixes, into the fives, there's an opportunity there. So if you're somebody that plans on taking advantage of that as it becomes available, then you need to factor in how much it's costing you to do that loan, how long you plan on having that loan, and does it actually make sense? Here, we said it was a 5-year recoupment period. So if you don't plan to have that loan 5 years, then it probably doesn't make sense. Some people say, hey, listen, I know in 2 years, I'm going to be moving. I'm going to Tennessee. I'm getting out of California. I can't stand this place. I hate, everything about it. I'm moving. If that's the case, if you're that person, then you probably shouldn't be worried about refinancing. You shouldn't be worried about paying points in those scenarios, because it's not going to be a factor that's going to end up affecting you. But one thing you didn't mention, Josh, are those people that ending retirement, coming to the end of being able to qualify for one reason or another, right? They're not going to have that income. There's something that's going to change in their scenario, and this might be the last loan that they get for that reason. In those scenarios, it makes a little bit more sense, right? It makes more sense to pay it down. Also, those people that they got 2.5% interest rates, they bought it down to 2%. Like, those were things we'll never probably see again. And if we do, by all means, at that point, maybe you should consider paying a little bit extra for a lower rate at that time. But those are really the times when you should consider it, and at the same time, when you shouldn't.
Jeb, let's talk about the number one reason not to, and the one that you and I get to see, unfortunately, all the time, especially when rates drop and people are saying, hey, I'm thinking about refinancing. Will you look at this loan estimate? Every one I ever get is never a 0-point rate. If you're talking to a call center, if you reached out to someone that sent a mailer to your house, you called on a billboard, they are going to start with some version of points. And you're going to look and you go, ooh, that rate looks awesome. And then you look at box A and you're like, I'm paying $7,000 of points. Why? Because the kid in the call center wants to have a really great looking rate to show you. And then he's going to gloss over section A and go, oh, it's not that big of a deal. You don't pay it at closing. It just comes out of your equity. So you got to ask yourself, am I comfortable trading $3,000, $5,000, $7,000 of my equity for a $40, $60, $80, $100 lower monthly payment? So that is the number one reason not to pay points, is because the person that you're talking to that's on the other end of the phone that you've never seen, will never meet, don't know who they are, probably hasn't been doing loans for more than 17 months. And you laugh, but Jeb, I closed a loan for a borrower in March. In November, he called and he had a loan estimate from someone. We looked up the guy's NMLS number. That person that was doing his loan, that was quoting him a loan, literally had not been in the business when we did his loan in March of 24. We're like, what are we talking about here?
So with that said, if you want an experienced professional, you want a stress-free process, make sure you reach out to the team using the link in the description of the video, theeducatedhomebuyer.com/start. We'll get you in touch with Josh and the team. At least get an estimate, another comparison, just to make sure you're getting a good deal. And the last thing, Josh, I want to talk about when it comes to refinancing and that sort of thing, because I don't want to just beat this to death, but people building debt, paying off debt. This is very common in doing refinancing, getting some cash out, whether it's coming in your hand or it's coming in the form of paying off credit cards, sometimes car payments, these sort of things. Understand that, yes, you are saving money by paying this stuff off, but many times you are trading by paying off a short-term debt, 50 months or 5 years, 48 months, whatever your car loan is. You're taking that and then you're financing it. You're trading that for a longer term interest payment on your mortgage, right? So just make sure you're considering everything. It's not always quite as black and white as it seems, or as the loan officer makes it appear. Hey, you're saving $900 a month. You might be, but maybe you were able to save that by going a different way as well. So it's having that expert on your side and not somebody that's truly trying to sell you a bag of goods just so that it can do a loan. And I think that's, yeah.
I had a loan officer or someone relate to me what the loan officer was telling him 2 weeks ago. It was a $200,000 loan, a married couple. So married, you're up to almost $30,000 as your standard deduction. He was telling them to pay off like $50,000 of debt, including an auto at a lower rate because they were going to get tax benefits. And I said, what tax benefits are you going to get? I mean, this is the quality. Unfortunately, it's a very low barrier to entry business. You are getting people trained on sales pitches, not trained on financial advice and giving you a better financial future. So at risk of beating a dead horse, just make sure you're working with someone who is a mortgage advisor and not a salesperson.
And you can do that by using that link in the description of the video. So now the reason you guys all came here to learn how to do a free refinance, a free loan in some cases if you plan to take it that way. But Josh, lender credits. Let's talk about what a lender credit is. We've talked about the par rate. Let's talk about how we maybe take a little bit higher rate and we get some money to offset costs.
Literally the exact flip side of you paying points. It is the lender paying you points. And you say, why would the lender pay me points? We talked at the top of the show. They want 6.75 for their interest rate today. You say, hey, I need some money. They go, okay, well, they have their calculator, their spreadsheet. They know what these loans are worth over the long haul when they're doing thousands of them, what they can expect to earn in profit off of you. And they go the other way. Say, okay, rates are 6.75. If you'll pay us 6.99%, we'll give you 1%. So that $5,000 instead of you paying at closing comes to you as a credit, and it reduces your cash to close by $5,000 in return for you taking a 0.25% higher interest rate. And we went back, it's about $85 a month higher in the monthly payment. So you're saying, I don't have $5,000, or I value the $5,000 more in the bank more than I do paying an additional $85 on my monthly payment. And it's that simple. Now, the thing to note, sometimes people will say, well, cool, how do I get $10,000? Where we are in the current market, you might be able to get that by going up another 0.25% from 6.75% to 7.25% instead of 7%. But the further you get away from that par rate, you have diminishing returns. They don't just keep giving you another point for another quarter up. So if you went up a full 0.5%, you might only get 1.75% instead of 2. And same thing on the buy down. If you're trying to buy it down, the more you try to buy it down, the more expensive it gets. They don't really want loans all that far away from their par rate. So this is the negotiation, or no, the calculation that you have to go through with your loan officer. What are my options? And Jeb, for us, when we start, a lot of times with buyers, the conversation is, well, we don't know what we want to buy. We want to look at 450, 500, and 550. So I'm going to send them 3 options, and they're all going to be 0-point options. Once we hone in on, hey, I want to be here, I'm comfortable, I can do the 500. Well, now we can look at, what if I pay a point? What if I get a point credit back? Because sometimes no one's ever gone through this, and until you see it on paper, it's a little bit hard to understand. So people like seeing it, and they're going to go, oh, no, I don't want a higher rate, or no, I don't want to pay another $5,000 at closing. And 85-90% of clients are going to end up at a 0-point rate. But some people, for their personal reasons, look at the options and feel like a lender credit is better for them, or paying those points is. And I will say, when is the lender credit much more common? It is more common on refinances, because that borrower often looks at it and goes, well, I don't want to trade my equity. Or maybe they bought in the last few years. A lot of you listeners to the show have refinanced with us or have inquired about refinancing. You're on the rate watch list. And if you put 3% down, 3.5% down, 5% down, and you've only seen a little bit of appreciation, we don't really have a lot of equity to give up to trade in for a lower interest rate. So we hope that rates have moved enough that we can leave a little bit of that on the table and get that lender credit, and we're not having to increase your loan amount at all. So that is the situation that you found yourself in, Jeb. Hey, I want a lower interest rate, but I want to hopefully ride this down 3, 4, 5 times over the next 10 years. So your loan is big. Maybe there was $4,000 of closing costs. You know, if you look at doing it 4 times over 5 years as rates come down, that's $16,000, $17,000, $18,000 of your equity you would have given away if you had said, I want today's par rate, 0-point rate. So instead, both times you took a slightly higher interest rate. They gave you a credit. They covered all the closing costs, left your loan amount intact so that you're just riding that rate wave down. You don't have any sunk cost. You didn't pay points when you purchased. You didn't pay points or closing costs when you refinanced. So anytime that we see an opportunity with interest rates moving down, you or someone like you could feel free to take advantage of it, because you haven't paid money for a vanity interest rate anywhere along the way.
And something I want to point out, you can, as a consumer, as somebody that's going through this process, not truly know how some of this cost is getting paid and how it, you see savings, you don't see that you're paying points. It's built into your loan sometimes, right? And so instead of having that $500,000 balance on your loan, it might be 505 or 510, right? They're taking the equity that you have in that property and they're using that to offset the cost. In some cases, they're also taking you back to a 30-year term. Maybe you got a loan 2 years ago and now you only owe 28 years on that mortgage. Well, maybe they're taking you back to a 30-year term so that the savings are greater. So you just have to understand all of these different components. On top of that, if your lender is promising you free refinancing, or they did when you originally got that loan, run. It is a marketing gimmick. There is no such thing as a free refinance. There's always costs involved. It's just a matter of how those costs are offset. And understand, nobody's doing anything for free. The reason they're saying a free refinance is so that you come back to them and that you don't shop it around, and that, nobody else out there is promising you a free refi. So I'm going to go the guy that did, and I'm not going to talk to anyone else. Well, guess what? That's what they want. So if you're getting that free refinance, if you've already gone through the process and now rates are going lower and you're going back to that person, that's fine. Use them as a baseline, but also talk to our team, talk to someone else to have a comparison, just so that you can look at the rate, the loan amount, the term, the fees that are being charged. All of these things matter, guys. It's not a one number equation. There's multiple things that go on here, and they need to be able to explain it to you in a way that you can understand and that it makes sense. And sometimes it does make sense to pay points. Sometimes it does make sense to build it into your loan. It just depends on your goals, and everyone's goals aren't the same.
And I always talk about, Jeb, numbers never lie. And when you see them, when you see those options side by side, one of them will always speak to you. It's pretty rare that I put numbers, 2 or 3 options in front of a client and they're confused or unclear on which is best for them. I'm going to say 80% of the time they come back and go, ooh, that's the one. That's the one for us. And just to kind of close the loop on the thing that you were saying, 5 minutes ago, I said, you need to be working with a mortgage advisor, not a salesperson. Probably one of the key tip-offs and the easiest tells for you to know you're working with a salesperson is the free refi quote. And I'll do a free refi. That you're dealing with a salesperson. They have no interest in actually working in your financial best interests.
Yeah. So before you make that decision, just make sure you talk to an expert. You can reach our team, as I've mentioned a couple of different times, by using that link in the description of the video. But do us a favor, if you find any value in this content at all, hit the thumbs up, subscribe to the channel on more information like this, and make sure you stay tuned for the next episode. Until then, buy right, borrow smart, build wealth. Adios.
Amigos.